All right. Well, welcome back to episode 33 of the Real Estate Syndicator Live. And boy, oh boy, did we did we ruffle some feathers today. Topic, of course, is infinite returns. If you thought by any stretch of imagination I would have a different shirt on than this set infinito, which is Kenny's Be Infinite, since he's a big proponent of the infinite model. But yeah, it's not only infinite returns, but really this idea that investors, limited partner investors, are starting to, I'm going to say complain, but are kind of a little bit unhappy with some of the short-term turnarounds on some of these projects. It's a trend that we've started to see. Bethany and I have been seeing for, I don't know, the last 6 months. I mean, a lot of clients and non-clients, honestly, are turning things around. Like literally, they'll have it back on the market within like 12 to 18 months after closing because they've hit their numbers. And although that does sound like a good thing, I wanted to bring to everyone's attention that it isn't necessarily a great thing. And what really got me thinking about it is this great post. I don't know if you guys read it. Bear with me. It's about a 45-second read. So I'll just kind of read it to you. It's from Joshua Ferrari. I don't know if you guys know Joshua. He does a really good job on LinkedIn. So I encourage you guys to follow him. He's over at Ferrari Capital. What a great name, by the way. But this is a post that really caught my eye and is really the impetus behind the show. And so let me read it. It's about 30, 45 seconds. It's not too long. But Josh says, I was talking to a fellow investor last week, and he told me that he actually wasn't happy about the LP or NLP deal he was a part of that sold in a little over a year and returned above average projections. I felt his frustration, but was a little confused. So I asked him why, and here was his response. I expect my principal back eventually, but if I valued liquidity so I could constantly be searching for the next thing, I wouldn't be investing in illiquid syndications. I now have a capital gains and recapture that I wasn't planning on for the current calendar year, as the sale is closing quickly and unexpectedly. High RRR is great, but over a longer period of time, it's much more meaningful and impressive. Like 12% IRR on a 20-year hold is how you build true generational wealth, while a 30% IRR in 1 year, not so much. When you're invested in a great asset, what's the rush to sell it? Is it the sponsor's windows to hit the promote? That makes me wonder if our goals are truly aligned. What do you think? And what I think is really, and the main reason we have this live, is there obviously isn't a right or wrong answer. And we'll get to, what infinite returns are and the pros and cons. I definitely want to talk about that. But really, what came to mind that I made it on the post this morning is Russ Gray's, I'm quoting this one a lot because it came out of episode 7. If you haven't seen that, I encourage you to watch it. But Russ Gray from the Real Estate Guys, co-host of the Real Estate Guys, said, ask not what the capital can do for you, ask what you can do for the capital, right? And I think that was such an amazing quote, because it goes towards talking to your investors and figuring out what's in their best interest, not necessarily what's in your best interest or our best interest as syndicators. And so this is a great classic example. Yes, the sponsor can hit their returns. I also heard a great argument that, hey, people want to go full circle. You want to have a track record on your resume, right? So that's one of the reasons you might go full circle. And then the question is, well, again, is that in the best interest of the investors, or is that in your best interest? And so there's no right or wrong answer. I think at the end of the day, somebody was quoting on the community page about how some investors wanted to get out, and I totally agree with that. But I really wanted to emphasize the point that if you guys aren't, polling your investors or talking to your investors, we just spent actually a great weekend. Brad, you were there. Brad and Emily were there at Bethany's retreat, and we had Jay Scott and Ashley Wilson there, and they were talking about how they constantly are polling their investors, and I'm sure you guys are too. But some investors are going to want to stay in for the long haul. I mean, one of the reasons Kenny does the infinite return models, because if he ever gets out, his investors don't want the money. They're like, well, what am I going to do with this money? I just want to turn around and give it back to you. And if you don't have another great deal, that poses a problem for him. That's really his main impetus behind doing the infinite return models, because it forces him to have another great deal. And especially these days, great deals are harder and harder to find. And so again, doesn't mean that all investors want it one way or the other, but I really would encourage everyone to make sure that your offering fits the offering of the LP, and not everybody's the same. And so maybe one of the answers is to have, I was thinking of a way, maybe we can create, and I think Josh has come up with a solution, but And I actually invited Josh on the show, and he couldn't make it today. And so maybe we'll have him on a future date. But if there's a way to do one fund that could accomplish both. So if you wanted to be a short-term investor, there's a liquidity event, whatever, in the next 2, 3, 4, 5 years. And if you wanted for the long term, you could as well. That might be an option. I haven't really had the time to think that through. But certainly you could have multiple offerings going on at the same time. Or you could have one offering where the goal is to do a long-term hold, literally 10, 15, 20 years. It's a cash flow play. We're not looking to sell within 5 years. But if somebody wants to do that kind of deal, here's that offering, and then have a separate offering for sort of the quote unquote normal. But I am starting to see this trend more and more, and you'd think that investors would be super happy with high, above projected returns. But I'll tell you, just as look, I'm an LP investor myself. Don't have time to go do all these great, amazing things you guys are doing, so I end up investing passively, and I don't want my money back. I mean, I want the cash flow, but I don't want to have suddenly, all that money come back to me, because guess what? I got to go turn around and put it somewhere else. And that means I got to do more work. I got to do more due diligence. I got to figure out where to place it. So I am in the camp. I wouldn't say I would be unhappy if this were to happen, but I am in the camp that I really would like to see an investment more in the 10, 15, year or plus horizon that gives me cash flow, and giving me that cash flow back through the infinite return model, which I'm a big fan of, and I think a lot of us are big fans of. And it's obviously getting harder and harder to do these days because the margins are not as good as they were, 10 years ago or 8 years or 7 years ago. But let's talk about the infinite return, because that's one way to sort of maybe satisfy both things. Because in the infinite return model, as you guys know, or could know, or should know, or maybe like to know, is that the idea is that you're actually you're not exiting the deal. You're actually just getting your principal back, but you continue to be an owner in the company at the exact same percentage, and you continue to get that cash flow, even though your principal is off the table. And then you can get to decide what to do with that principal. If you've got it, if I invest $100,000 and I get $100,000 back, and I'm still getting the cash flow, it might be a little bit less than I was before, but it's, I've got my 100 grand back. Then I can determine whether I want to go put it back into the same sponsor, if I want to sit on cash, if I want to, it's up to me to do whatever it is I want. But the infinite return model in the real estate syndication world typically happens through a heavy value add structure, which I think most, not all, but most syndicators these days, at least our clients, are doing, which is you're buying a property that's underperforming, and that's why you're getting it at a good price. It needs a lot of work. Sometimes it's cosmetic, sometimes it's major. And you're finding ways to add value to that property to increase the occupancy, to increase the rents, so that your net operating income goes up. And that allows you to go to the bank in 2 or 3 years and get, whatever LTVs are going around these days, but 50, 60, 70, 80%, well, 80, 60, 70, 75% loan to value on the new value, which allows you to not only pay off the original loan, but it allows you to actually return some or all of your investors' money. And when you return all of their money, that's where you get the infinite return, because the investor remains the same ownership as they did before, but they no longer have any skin in the game. And so I would say it's free money, but it's money that your money is no longer going to work. And one of the pros, I want to get to pros and cons, but one of the pros of that, which I think most people overlook, is the opportunity cost, or in this case, maybe the opportunity benefit of an infinite return. Because when you get your money back, you're still earning the income from the original property, but you're going to go deploy that money somewhere else and earn, maybe you're earning a 10%. Let's say the second investment, you're getting 10%. So think of the example. I put 100 grand into a property. Let's just say for math purposes, I'm getting a 10% return. So I'm getting $10,000 of cash every year. I get my money back. I then get to put that money somewhere else and start earning 10% somewhere else. So I'm getting $10,000 from that second investment with the same 100 grand, 10 grand over here. I'm probably making a little bit less than 10K over here, because, when you refinance, you get a higher loan. And so the net cash flow is a little bit smaller, but I'm still probably getting, 5, 6, 7 grand from that original investment. So now I'm making 12, 13,000 off my original 100. And if you can somehow pull off a third time, you can see how the velocity of the money really increases your returns. And I think that's something that most people don't think about. Now, again, these days it's harder. I think I don't know if anybody's being able to pull cash out refinances on the first one, where it's hard to do a cash out refinance and improve the property to get all of the investors' money back. But we still have clients that are returning, a significant portion of that. And it might take 2 refinances or a second supplemental loan after a certain amount of time to get that money back. But I think that's the benefit of the investor returns. But I just thought it was interesting that this is something that we've been hearing of, and through our clients, obviously, and then to see Josh's post, it's Josh or Joshua, but to see his post the other day, I thought was pretty cool. So anyway, let me go through some of the pros and cons that not only have I thought through, but actually was great today. There's a lot of back and forth in the community, and even on LinkedIn, but especially on the real estate syndicator community. And so here we're kind of cool. The pros, obviously, we just talked about one of them. The pro is a lot of investors don't want their money back. Like, I don't want my money back. I want the cash flow, but I don't want my principal back, because that just means more work for me, right? I'm already busy. I already got stuff going on. I've already done my due diligence on the property. You know, I don't want my money back. Opportunity cost is obviously another one that we just talked about. The tax benefits are also huge, right? Because when you sell a property, you end up with a huge, as the post mentioned, a capital gains tax that you've got to deal with. And especially if you find out at the end of the year, that might create some tax planning problems. But with an infinite return, because it's debt, that you're actually pulling debt out on a cash out refinance, that money that gets returned to you, whether it's the first time or the second time, that's all going to be tax free. And not to mention the no capital gains. So you've got the distributions that are coming to you from that refinance coming to you tax free, and then also the fact that you're not actually having to pay capital gains tax, so that if you're even getting returned more than 100% of your capital, eventually you're not having to deal with it. So there's tax benefits going on there. And I think the other big one that somebody was mentioning, which I thought was an excellent point, that it's hard especially these days, to find a good property. And not only does it take time and effort and relationships and all that stuff to get the acquisition, but these days it's becoming harder and harder and harder, especially with our debt increasing and our costs going up. And so if you find a great deal and it's cash flowing nicely and all that good stuff, why would you sell it? So anyway, I think those are the pros. And then of course the cons. I don't say this is a cons, but sort of the opposing view. And again, there's no right or wrong answer, but I think the opposing view is that, hey, some investors do want their money back. Right, some investors do want to have that freedom to do what they want with that. I'm using the $100,000 example, but obviously it can be more or less. But hey, I like the idea of getting my money back in 2, 3, 4, 5 years, and then I have the option to either reinvest it or do something else with it. So I think that's definitely a reason not to do it. One of the other ones that I think some of our clients definitely bring up when this topic comes up is, after holding the property, as you guys know, for 5 or 6 or 7 years, there's some wear and tear that starts happening, and typically you need some more CapEx going into the issue. And so, you probably need to go either figure out a way to get some additional capital to improve the property. And so that's one reason people like to just exit at that point, because then they can leave some meat on the bone for the next syndicator, and they don't have to deal with actually having to come up with the cash to continue to renovate and increase or keep the property at the level it needs to be. The full cycle one is another argument that I was hearing. Again, yes, that's positive for the sponsor. Yes, if you're going to go, having a full cycle on your resume and on your track record, that's obviously important. We talked about, I don't know how many episodes ago, about the top questions that limited partners should be asking a syndicator. And that was the first one, like, what's your track record? What's your experience? And so having that in your resume obviously is helpful. But again, if putting my completely unbiased hat on, I would say, well, who does that benefit? Does it benefit the syndicator? Does it benefit the limited partner? And I think that's some of the friction that we're seeing. Again, friction is maybe too strong of a word, but just some of the things that limited partners are thinking about is like, hey, is this really in my best interest to exit after 18 to 24 months, or is it more in the best interest of the sponsor? And then I think one of the best arguments, at least today, is, a lot of us feel that we might be, maybe at the top of the market, or at the very least, a lot of these syndicators, especially the new syndicators or inexperienced syndicators, have been purchasing, I think, properties at the top, a little bit frothy levels, and have been really bailed out by the cap rate compression and basically the market bailing them out. I mean, let's be honest, like it's like in the old days with the stocks. Everybody, I think Warren Buffett even said you could just basically throw a dart at the newspaper and just pick a stock and you make some money. And it's obviously not the same here with the real estate, but a lot of people are not really performing. Again, Ashley made a great point at the retreat and I think she mentioned it at the Bigger Pockets conference, where a lot of sponsors are hitting their ROIs, but they're not hitting their pro formas, right? They didn't hit their numbers. The only reason they hit their ultimate numbers was because the market went up. So when they ended up selling, the IRR was there, but they didn't hit their occupancy numbers. They didn't hit their NOI numbers. They didn't hit any of those internal numbers. They just hit their numbers overall because of the market. And if you took a look under the hood, again, it was the market, not necessarily the sponsor. So again, that's, I think, one good argument to have, like, hey, let's get out now. There's a couple of comments about that. So anyway, I'd be hugely interested in your guys' thoughts on that. If maybe have a couple of people talk about. Well, let's do a quick poll. Who here is in the camp of the concern of this investor that, hey, maybe we should start looking at longer term deals and not flip out in 2 or 3 years? Can I just get maybe a raise of hands or a comment there, and maybe I'd love to hear from you guys to see if there's any reasonings other than the ones that I mentioned. So Angela's long term. I see Brad raising his hand. Angela, you had a question. How does Ken handle the wear and tear? So he just continues to raise. I know he holds. It's going up. Yeah. So the wear and tear is something you got to deal with, and that just means you're distributing less money to your investors. But think about it. I mean, especially when you get to the point where you're raising, $20 million. If you're returning all the investors' money, that means you're investing. You're reinvesting $20 million. You can hold back $3 or $4 million in order to do those improvements. But so that would be sort of the idea. But anybody want to comment? Scott Henson's got his hand up. I don't know if that's just saying, hey, I'm in favor of the long term. Scott, you want to comment at all if I missed any of the reasons you believe that? And I'm not forcing you to come on either, but you are muted. You need to unmute.
No, Mauricio, I was just raising my hand to the long term.
Cool. Yeah, Eric says maintain a reserve account for the wear and tear. So anyway, and then anybody really steadfast about just, hey, it's a 5 to 7 year hold and forget about this infinite return, and it's a good deal for them to get out early. Anybody want to comment on that? Anything I missed, I guess, is where I'm really looking at. Is there any pro or con that I missed? Susan, I see your hand up there raising. Susan, you want to add any more from my pros and cons? That I'm sure I missed a ton of them, but those are the ones that kind of came to mind.
Well, I'm just curious. I've seen this division, and in the syndicators that I've been around as a passive investor, it seems weighted towards the, if you can flip it sooner is better. And I've assumed that it was a younger person's attitude, or someone who's still, really hungry to build net worth, as opposed to someone who might be a little bit older and, just wants the cash flow. So this was the first time when I saw your promo for this subject, this topic, this was the first time it occurred to me, there might be some other rationale than just like a younger person's attitude versus the older person's attitude.
Yeah. And I think, again, I don't think there's a right or wrong answer. I think that's my underlying thesis for today's thing is I didn't think about it in terms of the age gap, but yeah, if you're a more seasoned investor, you may care more about cash flow and security and steadfasting and that kind of stuff. And if you're a young millennial and you may just want to be flipping and turning and whatever 1030. By the way, I forgot to mention the other thing that we've seen a lot lately is this idea of 1031ing, if that's really a verb, but 1031ing into larger syndications, meaning you've got a syndication group, you hold the property for 3, 4, 5 years, and instead of selling, you actually just 1031 into a larger property. You raise up some additional capital from new investors. It's usually a bigger deal, but that's another way that I hadn't really made that connection. But that's another way I think people are sort of extending that time frame. Instead of getting out in 3 years, they're getting out of this property, but the investor is not actually getting out of the offering. So that's another, maybe in parallel to an infinite return model, is this 1031. Now, the key on a 1031 is you want to make sure you're disclosing that on the front end. So it's not something you can just think about, oh, hey, why don't we just 1031 this instead of selling it? That's a huge material fact that you better have disclosed, because there's a lot of people that are going to argue, hey, if I knew this was going to be a 10-year deal, I wouldn't have invested in your deal. I was expecting this to be a 3 to 5 or 5 to 7 or whatever it is that you represented. But yeah, like I said, I think they're different. So I'd like to, again, think about or encourage thing, and this is just to get people thinking a little bit, to think about having maybe multiple offerings out there that then appease the different types of investors. Because again, not one shoe does not fit all. And I go back to this whole idea of, as a syndicator, what Robert and Russ and a lot of our other mentors teach us is to listen, because it's all about the investors. That's what you're looking for. Like, what's in the best interest of the investors? How can we help the investors? What do they need? And once you figure out what the investors need, then you can put together and tailor a product that serves those needs. So anyway, thanks, Susan. Great to see you guys. Missed you. I don't know if you guys were in NOLA, but I know a lot of you guys were in New Orleans, and I ended up not being able to go. All right. Well, I think anybody got a specific question? Let me just go through here. Question or comment? I would love to hear comments. I'd like to get this discussion going, continuing. And then if not, I'll open it up to questions. And if you're enjoying the content, always forget to mention, to hit that subscribe button if you're listening to this on YouTube. So if you're watching this on YouTube, I appreciate the subscribe. And I saw David Fabry's hand pop up. Hey, Dave, how you doing?
Doing good. Yeah, I missed you in New Orleans.
Yeah. By the way, let's all focus on David's amazing voice that is a podcasting radio voice. Go ahead, David.
No, I'm competing with you.
I'm screwed if that's the competition.
So it occurred to me that maybe the reason for the 5 to 7 year hold, or the 3 to 5 year hold, and turn is maybe a marketing thing that they're trying to, that liquidity event at the end is what gets them their IRR, and out in the marketplace, one deal is compared to the other on a return basis.
I think that's a major part of it, and I think I just go back to the quote from this particular investor, which is, it just makes him wonder whether the goals are truly aligned, right? Because if that definitely is a goal of the sponsor, and it's something that we all want as our resume, but is that really what's? And look, at the end of the day, you do have a fiduciary responsibility, right? You do have a fiduciary responsibility to act in the best interest of the investors. But yeah, I think that's definitely one of them. Thanks, David. I just forgot Ben. I don't know if Ben's on here, but Ben Franklin asked a great question, I thought, in the community. And so I want to read it and then answer it. Just again, this is more of the mechanics of it. But Mauricio, when you see a waterfall for a sponsor that typically holds a refi rather than sells, how does the IRR hurdle work? Let's say it's a 13% IRR and then a 70-30 split. Does the IRR need to be hit once or get reevaluated every year once you do that refinance? Because if it's a long-term hold with infrequent refis, I would imagine it's very difficult for the sponsor to ever participate in cash flow even after the first refi. So anyway, so what we were talking about with Ben is, and again, this isn't the way it has to be, but I would say this is probably the standard and certainly what we draft in our documents. But anytime you have a refinance, we consider the refinance as the same as, so it's an equity pool, right? So it's very similar to a sale. And so typically you want to have, once you've paid off the prior loan and all that stuff, 100% of that money is going to go to your investors before you get any split from that refinance. So 100% of the money to get their capital down. And the good news is that your preferred return, or the hurdle, typically, and again, it doesn't have to be that way, but typically is based on your new reduced amount. So if I've got $100,000 in the deal, you return $60,000 to me, so I only have $40,000 in the deal. Well, my pref is going to be based on that $40,000, not the 100. So that benefits the syndicator. And of course, if it goes down to zero and we've completely taken out or returned all the capital to the investors, then there shouldn't really be a pref. I mean, the whole idea of pref is to spread out the risk. But I think more importantly, on the back end, when you do finally sell that asset, whenever that day comes, or if you do a second refinance 5 years from now there's no money to return to the investors. You've already returned all their capital, so you get to participate in profits from day one. So there are benefits for the sponsor to pay down that capital. It just becomes, look, I think the capital that you have for investors, the equity capital, is probably the most expensive on the capital stack. So being able to pay that down and save yourself that not interest rate, but that return, especially if it's a pref, it does help. But those are the mechanics of it. Again, it doesn't have to be that way. I've seen people refinance and investors are out. Right. I haven't done that in a while, but I've done 1 or 2 deals where people said, hey, we're going to refinance, we're going to pay you your money back, and then you're completely out, which is obviously not on an infinite return model. But good, like I said, I love saying this all the time. You can structure these things however you want, as long as we disclose. So anyway, Scott, so that was I thought it was a good question from Ben. Let me just go through here and see if we've got any. Let's just raise your hand if you've got a question for me on. Let's start with this topic, and then I'll open it up to anything you guys want to talk about. But if you've got a question or comment on this topic, you want to raise your hand or just unmute yourself. I think that probably was working before. You want to just unmute yourself and ask it. If not, I'll open it up to the floor for any random question.
All right, I'll go again, Mauricio.
Yeah, go ahead. Yeah, of course.
So one question I have is that how can you structure a deal so that it's an infinite return, but more or less perpetual, like an infinitely and an infinite return? Is there some requirement to have an end date on your offering?
I wasn't following at the beginning. The second one makes more sense. So I think once it's infinite, I don't know how you get an infinite on top of an infinite.
Well, but a perpetual, I guess.
Yeah.
Perpetual
Yeah. So, eventually you got to figure out, I mean, again, you can do whatever you want, right? So if you want to say, hey, I've got it, you could have what we call an evergreen fund, right? We said, look, this is a fund that's just open forever. The challenge will be, at some point, investors are going to want to know at some point how they get their money out, whether it's just a bunch of refinances. But you could do, theoretically, under the law anyway, you could structure a deal. We said, look, we're holding these for cash flow only. We're never going to sell. And so if you ever wanted to get out for whatever reason, you would just have to go into the marketplace and find somebody who's willing to buy your 1.5% shares for a price. And maybe at that point, you've got all your money back, and and it's worth, the value's been increased because you've held it for 10 or 15 years. Maybe you can get somebody else to sell. But generally speaking, there's going to be some language in there that says, the manager reserves the right under their sole discretion to sell the property. Maybe they'll say after 10 years or whatever, but there's usually some language in there. And I think most investors at some point want to know a backup, or at least an intent. They want to know, are you planning on holding this for 2 years, 5 years, 10 years, 20 years? So I haven't seen anybody do something like that, but certainly there's no reason why you couldn't do it, under the securities laws anyway. Again, disclose, right? That's what we need to do. Mark, you got a great comment here. Mark Rios, since IRR is a derivative of net present value and discounted cash flow, an IRR waterfall requires cumulative compounding and return of capital throughout the hold, even with a cash out refinance. Yeah, I should have probably asked, Eric Stewart was on, although Russell Gray would probably be a good, since he's a spreadsheet finance guy. But I've always struggled, for example, when you're doing a cash out, and maybe Mark, maybe you've got a comment on this, but it's interesting to figure out how do you actually calculate your return? You can't just say, my return was infinite, because at some point you put some money in, you got some cash out. So there's going to be, and that's probably the IRR function of it. But in terms of what were your annualized returns, it was always tricky, especially on the pro forma. Let me just, I don't know if Mark unmuted himself, but here was always the challenging thing for me is like, let's say in year 2, the goal was to return, 50% of the money to the investors. So now they're in it for 50%. I was very uncomfortable then. Theoretically, you're showing now returns of like 20 or 30% on the pro forma because your basis is so much lower, right? And I always felt uncomfortable with that. Or even if you returned all the money, I mean, you want to put, what does infinite really mean at some point? So I don't know if anybody has I don't have an answer to that. It's just something that I've always been interested and fascinated when the capital, the base comes down. How does somebody actually figure out numbers? And Mark, maybe it's just as simple as IRR. And that's just, again, IRR, most people, I think, even I sometimes get confused as to what exactly IRR really means, unless you're a stocky. Who's that? Who's speaking?
No, this is
there
Mark.
he is. Hey, Mark, how you doing, buddy? Yeah, thanks,
Sorry,
buddy.
Just a real comment, quick comment on that. So what happens is, even though you have an IRR waterfall, you need the compounding, you need the cumulative, because that capital account needs to compound because it's net present value and that whole bit, discounted cash flow, time value, money, all that stuff. But each year you just calculate it as, the outstanding capital balance times the pref. And then when you get to the end, when all is said and done, if there's a capital event that pays everything back, you have to have a look, you have to have a look back feature in either a catch up or a clawback. And that's how you actually calculate the IRR. You can't calculate the IRR as you're going along. You have to estimate it. And then you use the look back to make sure that you did it right. So the IRR basically is at the end of the hold looking backwards. We use the IRR as an estimation looking forward at the beginning of a deal, but it's all kind of, crystal ball until you've actually done the deal and look back and calculated your actual returns.
And of course that doesn't capture, and again, that doesn't capture I'm going to call it the opportunity benefit, that I'm now taking that money that you gave back to me and being able to place it somewhere else and earn a return somewhere else.
Yeah, because you're getting little tiny bits, right? Because it's return of capital,
right?
You're chipping away at that original amount. Right. And yeah, you're getting $5,000 a year, $10,000 a year. You got to invest it, but hopefully you got a lot of deals so you can invest in syndications at scale. Otherwise, that money's coming back to you and sitting in an account until it builds up enough. Until it builds up enough size that you can go out and invest it in a syndication or whatever, with a minimum.
Appreciate it, my friend. Thank you. I should have gone earlier. There's a great, I don't have an answer for you, Huyen, but curious, have you done a survey with investors? What do investors want? Long-term, 10-year hold, or around 5-year hold? Actually, that's probably a question for syndicators, that you guys are always, well, hopefully you guys are talking to your list. What I was going to suggest is it's people have asked me before, and I think it's a great thing that I could do, is because we do so many of these and we have access to a lot of data, if there's some specific surveys you'd like us to perform and aggregate some data, like how many syndicators are doing this or how many syndicators are doing that. If there's any particular metrics that you guys would be interested in finding out, let me know, because I think at some point I will do that. I think it's super helpful for syndicators to know, what the market is doing in terms of, hey, what's the prep? I'll give you a simple one. You probably don't need this one, but like, what's the ongoing pref? Is it 7%? Is it 8%? What percentage of syndicators are doing a pref at all? But data like that, I think is helpful. But anybody want to maybe just put in the chat in terms of survey for the investors? Are they looking? Let me ask you this way: are you guys finding that investors want longer term holds, or are they looking for shorter term holds? Because I don't think we can nail it down for 5 or 10 years. So Huyen said, I'm a syndicator, and most of our investors want short term and get their money back as soon as possible. Right. And I would just argue, though, that if you can get the money back as soon as possible through a cash out refinance. Again, these days it's a little bit harder to do, but certainly 3 or 4 years ago, a lot of people were doing that. Wouldn't you rather get your money back and then stay in the deal? Or, if it's a great deal, why give up the cash flow? I guess that's my point. Mark says the biggest target investor has been a high paid tech folks. Many want out in 3 to 5 years because of liquidity. Interesting. Tracy, I would think that all syndicators should conduct that kind of survey, what the investors want. 100% agree. So syndicator investment goals and their investment goals are aligned. Yeah, I think that's one of my 10 questions, right? Is figuring out whether, or maybe not questions, but things to think about for the limited partners to make sure that the goals are aligned, right? I'm always thinking about cash flow versus, if you're a cash flow investor, if you're looking for security and you want cash flow, probably doing a development deal that's not going to pay you cash flow for the next 3 years or 2 years isn't the right thing to do. But yeah, I think alignment is a huge thing. And that's why, again, going back to Russ's quote, he always talks about listening more than talking and trying to figure out what does the investor want. Because one of his other famous quotes is, as you guys know who have been to his sales event, it's never, ever, 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 ever about you. It's always about them. So anyway, so I think conducting surveys, if you guys aren't doing it, I would highly recommend doing it. I know that Mark, you and your team are doing that pretty regularly these days. Eric is in the house. Agreed. 3 to 5 years seems like the common desired timeline. Yeah, I think I might do some kind of survey. Any other questions? It looks like I think we've run out of questions on this topic. So anyway, I thought it was an interesting topic. Glad you guys thought about it. I saw quite a bit more engagement on today's topic than we usually do. So anyway, don't miss next week. Kyle Wilson, marketing genius. If you've got your marketing questions, bring them. And super appreciative of you guys being here. We'll see you next week for episode 34. Thanks, everyone.